right, it looks like we're live. Hello, hello, hello. Good morning, good afternoon, good evening. Welcome, welcome, welcome to the mini class series to diversify or not to diversify, part 2. I'm Millen Livis, financial independence mentor, and I'm excited to share with you, especially if you're already an investor or want to be a strategic investor, to share with you both sides of the diversification story, because everything has a front and a back, right? So last time in part 1, I talked about 3 benefits of the diversification of assets in your portfolio, right? So if you haven't seen this part, you can find it on this page, or you can go to my YouTube channel, Millen Livis Channel Wealth, and you can find a recording of this part 1 of this mini class series. So today we're going to talk about dangers of over-diversification. And by the way, if you join me live, feel free to post your questions. I promise I will answer all your questions at the end of this mini class series, because I want to respect your time. So when it comes to diversification, some beginner investors get confused about the degree of diversification they need to maintain in their investment portfolios, because there are so many choices out there of financial products, right? So how many should you have? And while diversification is a smart risk management strategy, and I talked about this, like I said, I talked about the benefits at length in part 1 of this Wealth Building mini class series, this strategy must be approached wisely. There is an old saying, which I believe it's true: everything has a front and a back. Everything. I don't know if it rings true to you, but I believe that it is true. So today, I want to share with you the back side of the diversification, which is over-diversification, so that you will be aware of what not to do. So over-diversification is a common mistake that can significantly decrease the returns from your investments compared to the risk of losses in your portfolio that you mitigate with the diversification strategy. Because most investors are aware of the harmful effects of under-diversification, many mistakenly believe that the more diversification, the better, right? This concept is false. This concept is false and can lead to a significantly diminished returns in your investment portfolio. It's like getting natural vitamin D from the sun, because it's essential for your optimal health. However, receiving overdose of vitamin D from the sun radiation through the extended exposure can lead to serious health issues. So that's kind of maybe would be easier for you to understand why over-diversification is dangerous. So how the over-diversification happens? Over-diversification happens when the number of investments in your portfolio, in your investment portfolio, exceeds the level where the loss of expected return from your investments is greater than the benefit of reduced risk that you mitigate through diversification. When you add investments to your portfolio, it lowers your risk of loss. But there is always a but potentially it also lowers the expected return from your portfolio. So for example, let's say you own 1 stock instead of 1,000 stocks, right? So if you own just 1 well-performing stock, your expected return or gain from investing in this stock is very high, but so is your risk, right? Because it's just 1 stock. So your entire portfolio performance will depend on the performance of this just 1 stock. In part 1 of this mini class, I shared with you my story when I invested all my retirement funds into the stock of the company that I worked for at that time, Morgan Stanley. So this portfolio performed fabulous. My investment portfolio that contained this Morgan Stanley stock performed fabulous. Multiple returns on investments from my initial investment until the stock market crashed. Okay, so I hope that by now you clearly see the benefits of going from 1 stock to 5, or from five stocks to 20. Each time you add a new investment to your portfolio, it will lower your risk of experiencing devastating losses. It will. However, after a certain point, it will also lower the expected return from your investment portfolio. For example, and by the way, so far, are we good? Like, if you have any questions, like I said, please post them in the comments. I will make sure that I answer them. So let's go over this example. For example, if you own 1,000 stocks, you eliminate unsystematic risk. It's a risk, it's a term for the risk that is associated with a particular company or particular industry. So you will eliminate unsystematic risk if you own, let's say, 1,000 stocks. But most likely, your portfolio will not contain the best performing stocks and the highest quality of companies. I pretty much can guarantee you that a portfolio of 1,000 stocks, whether owned individually or through mutual funds or ETFs, exchange traded funds, will contain a wide range of opportunities, from the best, from the very best, to quite bad ones. So there will be some great picks, companies that perform phenomenally and have a lot of cash on their balance sheets, etc., and have great growth potential. But you will also have quite a few losers if you have a portfolio of 1,000 stocks. So in other words, what I'm trying to say here, at some point in your diversification efforts, you can reach the number of investments where the benefit of risk reduction is smaller than the decrease in expected gains. So how do you decide on the optimal level of diversification? What I want to bring to your attention today is that owning only 15 to 20 great stocks in your portfolio, which are diversified among a variety of industries, would be a much better choice than owning 20 great stocks plus 980 mediocre or poor performing stocks, because this 980 will pull down the performance of your portfolio. That's why over-diversification leads to below average or even poor returns on your investment. And you may fall into this over-diversification trap by simply holding a few mutual funds, ETFs, and index funds that are this particular financial instruments already over-diversified and focus on quantity instead of quality. So some of this, because this mutual funds and ETFs, these are baskets of various financial instruments, and some of them already over-diversified because they have too many. So how to diversify your portfolio in a right way, in the most efficient way? I strongly believe that diversification is not simply a numbers game. It's not. As I demonstrated to you earlier in this part 2 video, the number of investments in your portfolio does not determine how risk prudent or performance optimized your portfolio is. The trick to successfully diversifying your portfolio is owning investments that play different roles in your investment portfolio. Just like having a team in your business where every team member has a specific role in order to achieve best possible results in your business, your investments need to have different roles in order to achieve best returns in your investment portfolio. Some investments meant to focus on growth. Other investments meant to focus on income, and yet others on value, meaning focus on value, meaning that you look for good companies that are going through transition and are currently undervalued. For example, Warren Buffett is a great and famous value investor. So again, so you've got to have your investment should have a different focus, right? That's how I diversify my portfolio. You can also diversify your investments by companies' market capitalization, like there are small, mid, and large caps. And you can also choose to own domestic and international companies from different market sectors. But to really optimize your investment portfolio, I invite you to consider adding alternative investments into the mix, like real estate or commodities. Because historically, alternative investments performance doesn't highly correlate with traditional assets like stocks and bonds. Okay? So when stocks and bonds are moving straight up or straight down, which they always do, alternatives can move diagonally. It's almost like taking an escalator instead of the elevator to your financial goals. With alternative investments in your portfolio, you may be moving a bit slower toward your financial goals, but you're also less likely to get trapped between the floors. Okay, so what is the bottom line here? What is the bottom line here? We talked a lot about the importance of diversification in part 1 of this mini class series. However, you've got to be aware of the dangers of over-diversification in your portfolio. So the optimal diversification of your portfolio would be to own a number of individual investments that are large enough to almost eliminate unsystematic risk that I shared with you, risk associated with specific companies or specific industries. So to own number of individual investments that are large enough to almost eliminate this unsystematic risk, but small enough to focus on the best performing opportunities that you may find for the long term. And that's all for this particular mini class series. I would love to hear from you. I really appreciate that you took time to watch this, whether you're watching this live or in recording. And I want to remind you that for more resources on various financial topics, check my page, daretochange.life.com, work with Millen. Again, Dare to Change Live, work with Millen. I will post these links below this video. And for additional real-time support, join my private Facebook group, Wealth Building for Powerful Women. We have amazing community there, very supportive, and very high energy. And I highly, highly recommend you to join if you want to have real-time support. And again, thank you very much for your time today. Happy investing to your health, wealth, and freedom.